Are you a real estate investor looking to sharpen your skills or a newbie looking to become one? You're in the right place. Welcome to Where Should I Invest? Real Estate Investing in Canada with your host, Sarah Larby.
Hey, welcome back. You are listening to Where Should I Invest? And it is Sarah Larby. And today's guest is Meghan Chomut, who is a good friend of mine. We've actually never met in person, but we've had many good conversations, Zoom meetings, phone calls, and it is great to work with some of the best financial planners out there that know how to incorporate real estate investing as part of the overall strategy. And she's also a real estate investor herself, a landlord, doing the buy and hold strategy. So in today's podcast, we're going to talk about how to protect your investments, how to ensure that you get unbiased financial planning advice. We talk about fees. We talk about the reality of real estate investing and what we see out there that is not always reality, and everything in between. So I hope you guys enjoyed today's podcast, and reach out to Meghan Chomut if you've got any questions about your overall real estate plan and incorporating everything from not only real estate, but insurance and your strategy for how to get to the next one, whether it's RSPs, tax-free savings accounts, all of those good things. Meghan is an expert at providing some unbiased recommendations. So I hope you guys enjoy the podcast and see you soon. Meghan, welcome back to the show. How are you doing?
I'm doing really good. Thanks for having me back. I'm excited.
Yeah, I mean, I've had so many great comments from the last time that you were on. And, again, it's just a great opportunity for us to revisit this, because there's always things that change. And there's always going to be some important things that we have to remember, even though we are predominantly talking about real estate, on my podcast. I think it's also important to talk about the overall financial picture, the overall well-being from a financial planning standpoint. Because it all comes together at the end of the day. So for those of you listening to this right now, if you haven't heard Meghan on the prior podcast, go back and search for that. It was lots of great information. But maybe we can do a quick 20-minute or 20 seconds overview of what it is that you do and how you help real estate investors.
So in terms of helping real estate investors, I have my CFP designation, which means I'm a certified financial planner, and I help people take a broader lens and look at where they currently are and where they want to be, and what exactly are the step-by-step things that they need to kind of check off to make sure that they're moving in the right direction. And in doing this, we need to consider all aspects. We need to consider savings, we need to consider debt, we need to consider especially tax consequences of every single decision along the way, because a decision that you make today can really have a dramatic tax consequence in the long, even midterm future. So that's really what I do, is I just take the broad lens and then we narrow in on looking at the bite-sized decisions that they need to make to get them to that goal.
Absolutely. And I wanted to have you come back, and I'm very particular in, and there's lots of designations, right? Financial advisor, financial planner, certified financial planner. I mean, it gets really confusing, but I wanted to have you back because there's not many people like you out there that are actually incorporating real estate into the overall plan. And I think that's just really important, because a lot of other advisors will A, not understand real estate, B, again, what's really their motive behind where they position your money. And so I think it's just really important to have somebody that you can work with from a financial standpoint that is going to not say, don't buy real estate, buy these mutual funds instead, and pad their own pockets. Are you able to just share a little bit about the industry and, maybe just a little bit of the different designations and what to watch out for?
Mm-hmm. So I started in the investment space in 2008, and I didn't buy my first investment property until 2015. So even with my background in finance and accounting and investments, I still didn't get a really solid picture of what property investing looked like until my feet were in the mud. So it's one thing to look at the numbers. It's one thing to hear tabloids on the news about tenants not paying rent or destroying your property. It's another thing to have your boots on the ground and actually going through the steps. So that being said, if someone does approach their financial advisor and they do recommend not to get involved, it's just because they don't really understand. And I've been there too. It does feel risky when you haven't had any experience doing it, or maybe you don't know anybody who is also doing it. So the way that people in this industry get compensated are a couple different ways. One is based on your investments. So as you slowly accumulate investments in maybe your tax-free savings account or your RSP, they feel really small, but there are little fees in there that go to the advisor for providing you with advice and guidance and a financial plan and all of that support. So it's one thing to do the investment. It's another thing completely if you're doing the investment with an advisor, but you're not getting any of that support. I also am a strong advocate to work with people who have maybe 5 or 10 steps ahead of you, or at least have, like I said, their feet in the mud too. So as you come across problems or questions, you know that you're going to somebody who might have already faced those same problems, and they can not only give you advice, which is by the book and what, you know, the theory tells you is the right decision, but also what they experienced themselves when they came across that same situation. So I'd like to say that advisors all across Canada they're trying to do the best for you, but there is that financial incentive for every dollar that you put into your TFSA or RSP or however you're investing. It does trickle back to that advisor. And if you want to take 100,000 of that money and put it towards a down payment on a property, it does come out of their income. So I'd like to say that there isn't a conflict of interest, but there is a monetary exchange there for sure.
Yeah, absolutely. And you know, compound interest, it's a wonderful, wonderful thing. However, if you're paying the advisor an extra % or 2, you know, once you factor in 20 years of time, hundreds of thousands of dollars, that is a lot of money that you are just, in my opinion, sorry, financial advisors, fee upfront is the way to go. You know, it's important that we as investors keep the money that we need to keep for investing and for ourselves, but we also need to have, in my opinion, financial advice. I just believe that we pay for it upfront. And so I don't, you know, maybe you can share a little bit about like how it works with you and your clients, if you don't mind.
Yeah, absolutely. So the way that I work with clients is I only get compensated from direct fees paid to me from my clients. So nobody needs to be worried that if I make a recommendation or I suggest maybe a type of product or something, that I'm going to get any kickback from that. If I say you should call so-and-so and so-and-so because they're really experienced mortgage brokers, it's because they are experienced mortgage brokers. It isn't because they're going to give me a piece of their pie. So there's absolutely no money that comes my way besides giving advice right to my clients. The other thing to consider is that when you work for somebody, or when you work with somebody that is fee only, it does feel like it's coming out of your cash flow, but it already is coming out of your cash flow. So if that financial advisor who's fee only like myself, we can show you how to better structure your investments, then you can wipe out those fees that you were paying anyways. For example, I had a education savings account set up for my kids with my previous employer, and my fees were about $2,000 a year. which honestly, I don't mind paying if I'm getting solid quality advice and really someone making sure I'm getting the appropriate rate of return and that I'm meeting my goals and I'm on track. And I got all those check boxes checked off, but I hadn't heard from them in a couple of years. So what had I paid, technically $4,000 for? I don't know.
Right. No, absolutely. So would you be able to share then like how, like how you support your clients along the way, like what that looks like? Are you talking to them on a regular basis? How regular?
So what I do with my clients is so for example, in terms of the fees are it's kind of like rent almost. It's like one larger lump sum deposit to get started. We get your file going, we get a financial plan going, and then it's a monthly fee after that. Every fee-only advisor is a little bit different, but I like to think about it like what you're getting essentially is a financial roadmap with 1 year of support. So you could take all those, 11 monthly payments plus that one lump sum and pay them all at once.
Right.
And I'll give you a financial plan. The problem with that is I'm going to deliver you a financial plan. And then in 3 months, you're going to say, oh, I got an opportunity to refinance and this came up. And now that financial plan I just did for you is kind of garbage.
Mm-hmm.
Because I feel like, especially with real estate investors, our lives are changing so quickly as opportunities or sometimes unfortunate events are happening. So the way that I work with clients is the first thing we do is I do have them get an assessment done by my client success coordinator, and she tells me what kind of person these people are. I find this very valuable, especially if there's a couple, because sometimes couples are complete opposites, which makes a financial plan and talking about goals and talking about structure and next steps very challenging. So this way I'm able to create some sort of dynamic in terms of the meeting in my deliverables and the way that I communicate with clients based on the type of people that they are. So we establish that, and then we move forward to say, okay, where are you right now? What does your picture look like right now? And if you were to do nothing, this is what happens. Do you get to your goal anyway if you're doing nothing? Most people know, but sometimes, if you're really fortunate, then that might be your reality. So then it's saying, okay, this is where you are right now. In 3 months, you need to be here. So we need to make sure, maybe for some people, it's a little bit shorter, it's a little bit longer based on their goals. So in general, what I have established is at first, for those first 2 months that we're working together, we're in constant communication. So it's weekly, it's for sure monthly, it's here's the deliverable, let's hop on a call. What do you think? What kind of questions do you have? And then within 8 weeks, you have a set financial plan for that whole year that we're going to be working together. And what I do is every quarter, we do what I call a progress report. So where were you when we started working together? Where are you now? And is it meeting those stakes in the sand that we said you had to hit by this date and this date and this date? Because if it's not, then we either need to figure out how to get you a better rate of return, extend your timeline. Like there's things that we have to tweak. And if we're not moving all those gears at least every quarter, then getting to your goal is going to be quite challenging. So that's kind of how I work with clients. For sure, at first, it's very constant. And then it's every quarter we do a progress report. And then the thing about real estate investors is I always say to the clients, if you don't feel like you need to feel like you're bombarding me with questions, because a lot of us don't really know the full financial picture because we're so focused in one spot, because that's the spot we're trying to grow. Mm-hmm. And so at first it's constant.
Yeah, no, absolutely. That makes sense. And that is reassuring too, that you've got a plan that you're able to tweak along the way. So I want to take a little bit of a different step and just ask you a series of questions on what your thoughts are on, different products, if that's okay. I want to start with mortgage insurance. If you can share yes or no, I'm a big believer that to me it's not the right product. However, I'm not the advisor, planner. You've got, probably lots of questions along those lines. So what do you think about when your teller asks you if you want to get mortgage insurance?
For mortgage insurance, for some of us, it's important. We should be covering ourselves in the event that we are unable to, that we die, is essentially to protect our loved ones. The problem with bank mortgage insurance is that it is very expensive and it is not an ideal product. It's convenient, which is one reason why it's so expensive. So in terms of protecting yourself, well, not yourself, protecting your loved ones, should something happen to you, when you buy insurance through your teller, they're saying, we're gonna tack on an extra $50 a month. And if something happens to you, we'll pay off the mortgage. Well, hopefully that mortgage is going down as your tenants pay the rent. So you're paying a $50 set rate for something that's your benefit is decreasing. When essentially, if you needed the coverage on that property, you could probably get something that doesn't decrease. So if, let's say the property's worth $100,000, and in 5 years, it's the mortgage on it is now, let's say, 75. So the bank will cover that 75 if something happens to you. But if you were to have bought your own insurance, the mortgage provider would give you the full 100 and you'd be paying less. So it's kind of one of those things where insurance is important, but you really have to make sure that number one, you need it, because you might not even need it. And number two, are you paying for something that's of lower quality? And if you are, then don't get it.
Yeah, and I've heard, through the grapevines of them, because you're not technically underwriting it at that point in time. I mean, they're asking like 5 or 6 questions to people, but it's not actually fully underwritten. Where term insurance, like you've got to actually underwrite it at the time, and then you're set. But through different people, I've heard that sometimes they try to push back and say, oh, well, you know what, we're not going to pay it out because of this and this reason or whatnot. So again, I'm not the advisor per se, but it's like you've been paying this $50 or whatever it is per month, and are you going to actually be able to get paid out on the claim, or are they going to give you some pushback based on not having the underwriter do that at the time that you were actually answering those questions? And there's no medical, there's not a whole lot of stuff that was done, right?
That's a good point too. I actually don't know, because I'm not in that part of the product selling place, but the other thing is some people don't even know they have this. So they might have bought their place, and when they went through all the mortgage questions, somebody just selected yes for them. And they may have asked them in that moment, do you need insurance? I recommend you get it. And then maybe they did even give the caveat in there, I'm going to put yes here for you, but you should get covered yourself. So let's just cover you so that when you leave this building, if anything happens to you, you're going to be okay. Your family will be okay. But go and talk to an insurance rep and get something in place that is much better quality and much cheaper. But then you forgot. So I've seen a lot of people, when I review their mortgage statements, be like, okay, you have a mortgage insurance thing that you're paying here, $60 a month. I know, because I know you and I know your health and I know your age and how much you need, you could get this for $19. So you're paying $60, and how long have you been paying that? That money could have went to maybe another property acquisition fund, or maybe towards your debt, or you could have thrown it around.
Yeah, absolutely. It's good to have a second pair of eyes on this kind of stuff. What else are you seeing that people do that you're like, oh, you know what, we can easily fix this and this? Like, we talked about the mortgage insurance piece, but is there anything else that you're seeing out there that you have like a conversation with people often about, to help, them, figure out their financial situation. Maybe it's something that they've been doing that's kind of a not so good thing that they've been doing that you can easily fix, or I don't know, I'll leave it open for your interpretation.
If I were to tie this back to the people that I work with, in terms of buying their maybe first or second rental property, it's that number one, buying a property to fix a shaky foundation of a financial situation is, I promise you, not going to fix it. Trying to fix a financial foundation problem with a rental property is kind of like having a relationship problem and trying to fix it with a baby. It just stresses it out. So if you're buying your first or second property, it's really important just to lay everything out on the table, get super clear on what's happening and where the moving pieces are and what even are your goals. And I think that would be my second common thing that I see is people changing their goals maybe more often, or maybe the criteria that things fit into. So like I might be working with someone and they say, I'm interested in this type of property. I really encourage people to get a little bit more specific than maybe just the type of property, just because I call it the picky eater theory. Like, just be picky, because if you're too broad, especially when you're first getting started, there's a lot of variables that, what's that word where it's like shiny object? You start chasing that, I saw Sarah talked on the podcast about this, or I heard so-and-so is trying this, and you start, that shiny object. So I recommend, number one, don't fix, bad financial habits with a rental property, because it will, I promise it'll just be like gasoline on a fire. And be picky and kind of narrow in and stick to that. For example, if I wanted to look for if my thing was going to be I want a 3-unit, I want the basement to be this, I want it to be in this general area, and absolutely no, broiler. It has to have this type of heating. Then if you go and fall in love with a 3-unit and then you see that it has the broiler in the basement, it's got to be a no. You have to just stick to that picky eater theory for at least 6 months, just to kind of shoot away those shiny objects.
Yeah, I mean, it'll allow people to probably take action rather than just saying, oh, should I do this? Should I do that instead, right? I mean, there's lots of strategies. As you were saying that, I was thinking, okay, you go with the BRRRR strategy. Somebody else might do buy and hold. Somebody else might do pre-construction. Somebody else might do, rent to own. Maybe you just start with a strategy and then just narrow that down from there. I think that's great advice. So I'm going to ask you a few more questions just to get your opinion on things. What do you think if somebody has debts, and I'll leave that open to your interpretation, but they also want to be investing? What should come first? Could it be done in conjunction? And if so, how?
Yeah, you absolutely can have debt and still, I think that there is something going on. I don't know if it's in media or just pop culture where debt is bad. Debt is just another tool in your toolkit, as far as I'm concerned. And if you have access to it or you have it, then it's just something you have. It's not bad or good. The problem I can see is if you're already struggling with your debt repayments, maybe investing should take a back seat for a little while until you get some stability. There's absolutely nothing wrong with having debt and starting to invest. That shouldn't stop you, as far as I'm concerned.
Yeah, I mean, I guess it depends what kind of debt too. Like if it's like credit card debt and it's like 24% versus like a HELOC or something, you know what I mean? Like that's very different debt from one to the other. But I do agree with you. Like you've got to make sure that like it's being serviced correctly, first and foremost. Do you ever do any like debt consolidation, like roll like high interest debt into a mortgage to lower the payments? Like, if so, can you just maybe just walk us through like what that might look like?
Yeah, so if you do have debt, like Sarah was saying, that's maybe credit card debt, high interest, rolling it over to something like a HELOC, if you have the opportunity to do that, is a great opportunity to save you on interest. So for most of our credit cards here, they're like 19 to 24%, and that can get really significant. Like Sarah mentioned earlier with the compound compound interest, it works in your favor absolutely if you're investing. Unfortunately, the compounding effect of interest has a real negative impact if you start struggling making your debt repayments. And so if you can ease the burden by switching that 24% to maybe something more manageable, like 6%, even something, half of the interest rate that you're paying, every dollar that you're putting towards debt will go more towards the principal that you incurred on your credit card, maybe to finance COVID life while things were hard. Every dollar will have more weight because less of it will be going to pay interest. So it's one of those things where I'm not a huge advocate of consolidating. I would love for you to just pay it off. And if consolidating it is going to prolong your timeline and make you more comfortable and maybe even increase your debt, I don't want to give you a crutch, but it is an opportunity if you need it just to get ahead a little bit.
Yeah, as long as like the reason that you got there in the first place is not repeated, right? For whatever that is. So how about this question? If somebody is looking to really create wealth, okay, let's just say they're 25, they've got a job, they're starting out, what are some of the things that you would recommend that they start doing at 25 to get, let's call it to, let's just say $1 million. Not that that is a lot anymore these days anyways, but let's just say they want to get to $1 million in 10 to 15 years, or whatever that number is. What are some things that you might want to say to them to start doing? Let's just pretend they don't have debt, because there's other things that factor in. Obviously, everyone's situation is different, but let's just say no debt, no school debt. They're just starting and they're making, let's call it 80 grand a year at whatever the job is.
Mm-hmm. Okay, good question. And I'm pretty sure I have a post on my Instagram that's exactly walking people through this. And of course, I'm using real estate because I'm biased. Okay. And I'm older than 25. But if I were to go back to being 25 again, what I would have done differently is I would have, instead of buying my first house as my starter home, what I would have done is I would have bought a duplex or a triplex, moved into it, and rent out the other 2 units. And then when I felt established and ready to go to the next project, I would do the exact same thing again. I think that when you're younger and you have more flexibility, if real estate is something that real estate will really accelerate your wealth, because not only are you going to get, I consider them like the property is like the goose and the rent payments are like those golden eggs, and you get both. So if you sell the property, you lose both. And that's what I would have done differently at, in my 20s, is what I would have done is I would have done that house hacking strategy of living in the property and then moving on. And maybe, now I have a bunch of kids and I'm busy and I struggle sometimes with real estate and because it is time consuming, I maybe would move over to the lending. I would get established. Yeah, that's what I would do is I would make my $1 million with the properties, the three properties, in terms of the rent payments and the appreciation. And then with my equity in those properties, I would lend it out. And then I would get those, not rent payments, the mortgage payments from those borrowers.
Yeah, no, absolutely. So how much, and then I want to go to the other side and pick on, somebody that's 50, 55, but for a 25-year-old right now, how much of their portfolio as they're doing this should be real estate specific versus, paper assets versus, whatever else? Like, do you have a percentage that you would recommend?
I don't have a set percentage because it's going to depend on every person. I think that when you first get started when you're 25, obviously if you buy your first rental, it's going to be a larger portion of your portfolio. But as you get those rent payments, you can do whatever you want with them. You could take some of them and put them towards paper assets. So in terms of what type of account, I am leaning more towards the tax-free savings account because it is a really great opportunity. Because what I'm finding now is when I'm working with clients that are, 55 and they're wanting to maybe sell their properties or whatever, the gains on those properties are so painful. And I understand that, if they make, let's say, $1 million in gains, it's you're winning, but that tax consequence is so painful that it almost limits your critical thinking to make that decision to put $1 million in your pocket just because you don't want to give so much of your money to the government. Mm-hmm. So I do like the tax-free savings account. I also do like the idea of having an emergency account that wouldn't be invested in anything. So you could put it in a high interest TFSA at the bank if you have the room. But when you first start out, a larger portion of your portfolio will be real estate until you have the opportunity to diversify.
Okay, no, that's interesting. And you mentioned a savings account and an emergency account. Like, how many months of expenses should somebody have in their emergency account? And then how many months should they have if they've got like 5 rental properties? And is that any different?
Yeah, good question. So the rule of thumb has been typically 3 months of expenses. And COVID kind of threw a wrench in that for a lot of people because 3 months of expenses really wasn't enough. So I would just start with the goal of being 3 months of expenses. So in terms of your personal situation, I would say your emergency account should be able to put food on the table, keep your lights on, and pay your debt obligations. So you would take out, if you were to have your budget laid out and you have, budget items for things like, getting your hair cut and, all those little silly things that you have to account for, just take those out because don't worry about that when you're going through an emergency. And just keep your lights on, keep food on the table and pay your debt obligations. Stop saving, stop all those little things and just what's that number times 3. And then same thing for the rental property. What are those automatic payments that you have to make? The mortgage, maybe you're paying utilities, property taxes, those types of things, yeah. Mm-hmm. Insurance, like all of those automatic kind of required payments. What is that number times 3? And so I've taken out those other, and they're very important expenses like vacancy, capital expenditures, repairs and maintenance. They are, but in the event of an emergency, it's just kind of doing what you can with what you got. So 3 months is normal, but after COVID, I think we all might be leaning more towards a larger number, something maybe close to 1 year.
Well, especially because the landlord-tenant board right now is like 12 months behind. So you imagine if you've got a tenant that doesn't pay, well, and you're carrying it. I mean, it might be 1 year, but the chances of 5 of the properties having that happen at the same time is probably fairly slim. But if you have a property and the tenant stops paying, I don't know if you necessarily need 12 months, but maybe, yeah, you're right. Like something in between, maybe 6 months, maybe 9 months. But now if somebody has 20 properties, are they getting 3 months per property? Like, what do you think about that?
I think they have to look at their overall portfolio and kind of make an evaluation there, because the other nice thing with, I mean, in terms of your personal, I always recommend having the cash. But in terms of rental properties, if you have access to something like a HELOC, maybe that's more of an appropriate emergency strategy. Because in terms of your going through an emergency, and like what is going through an emergency? Like really, like it's not that your furnace breaks, or it's not like an emergency is like somebody you love dies, your child gets sick, you lose a limb. Like those are the emergencies. They're things that you never thought or would never wish onto anybody. So in terms of the rental properties, maybe a HELOC is a more appropriate strategy, but for your personal, when you are struggling and you need to access debt to finance an already stressful situation, it is very anxiety provoking. So I never recommend a line of credit for the personal side of things to finance your life. But to finance your rental properties, I mean, the interest is tax deductible. There are strategies there. So in terms of having, a slush fund, it could just be one big slush fund for all your properties, not on an individual basis. And it could be a mix of a slush fund for the whole portfolio of properties. Plus, you have access to, 123 Pineapple Street because the whole HELOC's available. You were kind of saving it for maybe an acquisition or an opportunity or a lending, but it's kind of going to be your emergency fund now, just in case.
So it sounds to me like refinancing and getting HELOCs with the banks and the lenders that will allow it is going to be important in the overall plan.
I agree. I mean, I'm not a mortgage broker, and I feel like the lending environment is changing minute by minute. So I don't want to recommend that people always take advantage of it. But I mean, having access and not using it
it helps with your credit utilization ratio as well, especially if you're not using it. But I will tell you, you don't want to be asking for money when you need it, when you have a deal. It's just, to me, in my own personal opinion, again, guys, just work with a mortgage broker. But if it's available and you can do it, get access to money when you don't need it, and position yourself ahead of time. That would be my recommendation. So what about now somebody that's, 50, 55, they might have 10 years left or so that they want to be really working, and then they want to be able to enjoy the retirement years. What are some things that you might recommend for them? Maybe they own their house. They might have, I don't know, let's just say they own $1 million house, and they might have a couple hundred left to pay off on it. What are some of the things that you might suggest that they do so that they can, get to their goal of not having to work past, let's just call it 10 plus more years?
So somebody who is kind of just starting to crest over to that retirement, so they're getting out of the asset accumulation phase and going into the income requirement phase, it's going to differ depending on what was their plan. So you got to 50, and what did you think was going to happen? Do you have a pension? Were you going to do CPP? Were you saving in RSPs? Like, where were you? What do you got? If all they have is their house, there is the opportunity there to refinance that house. Look at the equity. What could you get from could you find a cash flowing income property that also meets the financing kind of requirements in terms of accessing your line of credit on your house you've done a great job paying off? The market right now, I'm seeing it's a struggle to find deals. So going long term is advantageous if you only have, let's say, 10 years even 10 years. So if you're 50 and you want to retire at 60, it's one thing, but if you want to retire at 55, that would be something different. I think it would be a mix. I think maybe like I said, you have to be picky, pick your strategy and try it. Maybe a joint venture would be a good opportunity. Maybe lending makes more sense. Dip your toes in, maybe doing something like mortgage financing. Like there's so many opportunities to get into real estate without having to go out and do it solo, like the lone wolf. And like you said earlier, it's like, there's no bad strategy. People are having so much success with every single strategy there is with real estate. It's just doing the right things one after another and in sequence.
Yeah, and also planning for a potential downfall at some point, right? And this is why like the cash flow is important. Yeah, you'll do well with equity in many markets, especially in Southern Ontario, but that's not always guaranteed, right? I mean, you'll likely build hundreds of thousands of dollars in equity, but you know, the cash flow that you have is going to help you sustain that property and yourself throughout those bad times. So I think it's also important to plan for the downturns, just because everyone looks like a hero in the good times, you know, and then you see what the strategies and you know, what actually worked out, because there's a lot of speculators out there, right? Like if you're buying a super expensive condo that your rent is only covering half your mortgage on, and you're still having to pay, you know, the rest of it for somebody else to live there, and you're hoping that it's going to keep going up. I mean, not my ideal strategy. Are people making money right now? They're making money. Down the road, if markets change and the market cycle, you know, takes a bit of a shift, that's not guaranteed.
Mm-hmm. I think too, if you find a property like that's the perfect BRRRR strategy, it's something different than finding the property that you can rent out right away and start seeing that cash flow right away.
Mm-hmm.
So I think that there's different opportunities for every age group. The trick with starting in your 50s when you want to, let's say, retire at 55, is you have to acquire either whatever like let's say you're going to go with rentals. You have to acquire your first one, acquire your second one, and now you are almost getting to that point where you may not be a T4 income earner anymore. So if you retire at 55 and you don't have a T4 anymore, it just limits your opportunity to financing. It's kind of like this juggling game where you want to retire, you want to reduce your income, but you need your income sometimes for financing, depending on what strategy you're going to take.
Yeah, or you go into commercial, you know, 5 units above properties, where at that point in time that could help. And then there are some like other lenders like trust companies and credit unions, and like, you know, the T4, it won't be as important, and they will look at different types of income. So they're a little bit more expensive than probably a big bank. But you know, I think there's still options. But yeah, I mean, if you've got a solid, steady, you know, decent paying T4 job, you know, acquire what you can while you have it. Because, you know, one of the things, like when I left my corporate job and I had a conversation with my mortgage broker, I could still qualify for quite a bit more than I actually thought, which is pretty cool from a residential standpoint. But I'm not qualifying with the typical banks. So I'm going to have to go to like trust companies, which it is what it is. But, you know, the rates are a little bit higher. The terms are a little bit different. The HELOC situation, flexibility is not the same, but I'm okay with that, right? But I think there's still things. It's just, you know, you'll still have to maneuver a little bit around it. What do you think is better between tax-free savings accounts or RSPs? And I know there's different situations, circumstances, but, you know, in your opinion, what would you recommend for somebody if they were earning, let's call it 100 grand? Let's just take a number and say somebody's earning 100 grand. They haven't put any money into either one. You know, what would you recommend that they do?
I like the strategy of going tax-free savings account as much as you can. And then at tax time, play around with the numbers, see what you need to be an RSP deposit, and then just use your tax-free savings account. It's kind of what I like. I would rather never have any money in my RSP, because my situation is I have a corporation, I have rentals, I have my own thing going on. And when I do retire, I want to make as much of my income tax-free as I can. And if I have to start drawing from not only my properties that are held personally, where I'm getting rent payments, hopefully, I'm drawing from that, but I'm also having to draw from my RSP, and especially people with pensions. Please use your tax-free savings account first, because yes, I understand that there is that savings element at tax time, but you're only just deferring that tax. And when you have a rental property, if you do decide to sell it, there's going to be that capital gains, and your RSP could essentially be a tool in your tool belt to be able to reduce some of those taxable gains. But then if you are considering doing some lending, some mortgage investing, then, it is nice to have that RSP piece accessible for that. So that didn't really answer your question, but personally, I do like the tax-free savings account and using RSPs as my second choice.
Yeah, absolutely. I mean, I think we share similar views. I think the only other thing I would just add to that is, like, if you've got a company that's matching, doing an RSP match. I mean, my company, for every dollar I would put in up to a certain amount, they would actually top it up $1.25. That's free money. Get that up until the top up. That is free money. There's no reason why you shouldn't do that. So I have RSPs. And the reason I have RSPs is because of that, right? So when I worked at Cintas or Lavazza, et cetera, and they had great top up programs, I'm like, I don't want to be not doing that. So you kind of put $1 in RSP, they give you whatever the match is. And I can tell you that adds up to quite a bit, but I do agree with you, if we do this right, we are not going to be poorer in retirement. We're going to be wealthier. And, that if you're wealthier, you're going to be in a higher tax bracket. So you're going to pay when you're going to be pulling out that RSP. And likely taxes are going to keep going up because they just do. So if you've got 20 years, 10 years or whatnot, likely the tax rates will be higher by then. You're going to pay more tax. If you did it right, you're going to be in a higher tax bracket. Now, so other than the match, I do agree with you. The tax-free savings account up until whatever the maximum amount that you can do per year changes every so often. Top that up, because at least you can retract, pull out the money tax-free. However, you have to be able to have the ability not to just take it in, take it out, put it back in, put it back out, use it as what it's intended to be. And you don't use it as like a, revolving line of credit or whatnot, because that you're going to miss out, I think, on some good gains that way. The last thing I would just say in terms of RSPs, if you've got such a high tax bracket, again, if you're in the highest tax bracket, it's going to be individual. But if you've maxed out your tax-free savings and you're in the highest tax bracket, you want to reduce that and get a refund now, potentially to, invest the money. It might not be the most horrible idea, but I think if people are in a lower tax bracket, putting in an RSP doesn't really make a whole lot of difference, because what you're going to get today back, if you're in a low tax bracket, is not going to be as good as if you're making, 150, 200 grand, and you're like in a high tax bracket. Your return on putting the money in year over year is going to be better the higher tax bracket you're in.
I 100% agree. And I think never, ever turn away free money. So if there's a matching program, start participating. And like you said about, I think some of the stipulations with RSP is that because it's a retirement savings plan, people don't feel tempted by it. But because of the verbiage of tax-free savings account, it almost does feel accessible. Mm-hmm. So like you said, if you're going to feel tempted to access your RSP or your tax-free savings account, even if you don't really benefit, it just for the behavioral and psychological aspect of it, it might make more sense to just throw it in an RSP. But honestly, if you can avoid that and just get into really strong not even really strong, just some good, some mediocre financial habits, then and the other thing that I didn't realize people didn't know was that you can have as many tax-free savings accounts as you want.
Mm-hmm.
I've been hearing a lot lately that people thought they could only have one. And I promise you, you can have 1 million tax-free savings accounts at every single financial institution. The only caveat is that you cannot go over your limit. So if your limit this year is $68,000 over the lifetime, as long as you've never put in more than that, you can have as many tax-free savings accounts as you want, and then you can name them. So you could say this tax-free savings account's for eventually when I get to go to Cuba, this one's for emergencies, this one's for retirement. Like you can have as many as you want.
Yeah, absolutely. The only other thing I would just say is before you start moving money in and out of your tax-free savings account, you've got to make sure that, like, let's just say, for example, it's February and you've got 50 grand in there, like you're taking it out. And then in March, you're putting another 50 grand. You've got to be careful because in the same calendar year, and maybe you can talk a little bit on that, but in the same calendar year, the stuff that you're taking out and putting back in, it actually counts, I think, against you. But like, maybe you can clarify a little bit what that is.
Yeah, it's exactly what you said. So if you had $50,000 in there, and let's say I'm the same person, I'm that $68,000 limit. So I've put in 50, it's grown to nothing, and then I take it out. I actually can't put that 50 back in if I want. I can only put 18 because my limit was 68. So and your limit doesn't reset until January 1st.
Yeah.
So if you were to take that money out, you can't put that whole 50 back in until the January 1st.
Until the next calendar year. And the interest that you're going to pay if you're above that is like not conducive to anything that you're going to make. So you don't want to be like, I'm going to put in like $500,000 in there, because I'll tell you, they're going to eat it up in fees, and you're going to pay through, a lot more than you want to anyways. So awesome. Well, thanks for that. And so Megan, the next part of the podcast is the lightning round. So I'm going to ask you 5 questions. Every guest gets the same, and you're going to give us the first answer that comes to mind. Are you ready to play?
I'm ready.
All right. Megan, question number 1, what is your favorite real estate investing book?
I hope I'm not giving the same answer as last time, but it's not really a real estate book. It's more behavioral, and it's called Blink by Malcolm Gladwell. Nice. And it's really about just trusting your gut.
It's a good book. I don't know if I have it here at the cottage, but we do have that book. Awesome. Number 2, I don't know if you are a podcast listener, but if you are, it doesn't have to be real estate related. Do you have a favorite podcast?
I absolutely do. I love Smartless.
What's Smartless about?
Smartless is with the guy from Will and Grace and the 2 guys from Arrested Development. Cool.
Is it like they're just going through skits or just talking, or?
So it's the 3 of them, and they have a surprise guest. So every episode, one of them gets to bring somebody on, but the other 2 don't know who it's going to be.
Oh, cool. Awesome. I'll have to listen to that one. All right. Question number 3, what do you do for fun aside from work and real estate?
There's a local ski hill here, and since, that's outdoor activities is kind of the activity of choice at the moment. I love to go skiing there with my family.
Awesome. Question number 4, if you lost all your money and all your assets tomorrow, how would you start again?
Oh no, that would be terrible. If I had to start all over again, I would borrow money to do exactly what I mentioned before. I would borrow money from somebody to do that duplex. I would live in it. I would pay that person back, and then I would do it again, and I would move into a 3-unit.
Awesome. With 4 kids.
Yeah, I would do that. Absolutely.
Nice. All right. And last question, number 5, if somebody has $50,000, they want to get started, how would you recommend they spend that money?
$50,000 and want to get started, I would recommend maybe taking some of it and getting some education, whether it's buying some support from a mentor, a coach, some books, some programs, and looking at the rest as going to your mortgage broker and saying, okay, I have this much left. What advice do you have for me? What are my options? What's my pre-approval? And then hopefully pairing the two, the lending side with now your mentor or coach or program or knowledge, so that you can pair the two and really grow it.
Awesome. Thanks for the advice. Meghan, where can my listeners reach out and find out more?
My favorite place to hang out is Instagram. So you can go over there. My handle is Meghan CFP. And then my website's meghanchomut.com.
All right, cool. I always ask this at the end. Any final last words of advice?
I think everybody who's listening to this episode is already doing great things by trying to acquire as much information and different strategies as they can. I just recommend going out and doing something with it.
Awesome. Thanks for that. And thanks for being on the show once again and providing so many great insights and advice for the listeners. Thanks, Meghan.
Thanks, Sarah.
Thanks so much for listening to Where Should I Invest with your host, Sarah Larby. Make sure to listen in next time. We'll catch you on the next episode of Where Should I Invest?